Welcome to this edition of Cattle Call. I'm Susan Littlefield. As Brad Koima is going to be joining us, with Koima and Varlick out of Sioux Center, Iowa. We've got, of course, the reaction with the higher prices in this grain market, the way corn has been acting. Cash market's been on the softer side, and then demand. How is this all feeding into what we call the bottom line for the cattle producers? We're going to look at all of that today. As Brad, we start out with that WASDE report. I think corn was kind of the silent player in everything, and caught many by surprise in the trade this week.
Yeah, you said it, Susan. This January grain report has had the notoriety, or the certainly had the in the past has been known as been a report that's been ramped with fireworks, and this one certainly did not disappoint. You know, a lot of us, I guess me included, thought that, well, the numbers on the soybeans ought to be all right, but maybe a little bit unsure on what they were going to do with the corn number. And then to have them slash the yield over 3 bushels an acre, which kind of drove the whole production number downward, of course, just obviously changed the whole the playing field here. We'd already had obviously a significant rally on both the corn and the soybeans, but that seemed to peg the market up to a different reality. And boy, it was certainly obvious in the cattle spreads yesterday, where the front 2 months were quite a bit lower, and then all the deferreds were a little bit higher. And I think that's maybe something we're talking about, Susan. The fact that this higher priced cost of gain is the futures market is certainly anticipatory, and I think that there's some reality to what does that mean in terms of marketing short term with a higher cost of feed.
So as you look at that, I mean, was there some knee-jerk reaction maybe coming from the cattle industry when they saw that feed price take a jump like it did in such a short time?
Nature of the futures, of course, is to overreact, Susan. Yesterday, when some of those spreads changed almost up to $2, where the back months were up 100 and the front months were nearly down 100, seems to be a little excessive to me as well. But a couple of problems a little bit with the market is that the short term of the market, we are carrying plenty of a premium to what was a softening cash market anyway. Friday's cash was softer than the cash on Thursday, and then yesterday's cash was lower than that, and today's cash is lower than that. So you've got a packer that is able to get cattle bought cheaper. Some of that certainly influenced by the fact that the cost of gain has changed a lot. Look at it this way. So let's say the cost of gain was 90 cents, 95 cents. And that's on a steer that maybe, say that thing weighs 800 pounds and you just bought it. Okay, so now you got a steer that weighs 1,500 pounds, and corn has just changed 85 cents in the last handful of days. Now your cost of gain arguably is probably at market value, where we're getting to $1.06, $1.08, $1.10 for cattle. Cost of gain is probably that or more. You can see why there's willing sellers. Guys just want to offload it. Let's get rid of them. Let's buy something that's cheaper to feed. Let's get out of the way. And that, unfortunately, there's a fair amount of reality to that. That's happened almost every other time we've had a high-priced corn market or higher-priced one. So that's certainly the influence. Now, short-term pain, long-term reason for some optimism. As you take weight off of the market, pull some cattle forward, you do create less tonnage, less cattle even arguably. And I don't really think you got to worry too much about female liquidation at this point, not in January, because we've done that for 2.5 years already. So yeah, I'm long-term friendly too. The short term, I'm afraid we've got to swim with the crocodiles for a little while, Susan.
So how current are we right now in the north?
Well, it's better than it was, but to say it's great, I would not dare to go that far either. Last week's comprehensive weights, they come out on Thursday, was the first time we saw a significant drop in the steer and heifer carcass weights. We were actually down 9 pounds from the week prior, and now we're 6 pounds over a year ago. So yes, still over a year ago, but we went through a long period, Susan, where we were 30, 35 pounds over a year ago. So it's getting better. You've had a bit of weather that's probably slowed some of these, what had been perfect conditions for months, where these cattle, like my dad would say, they grew 4 pounds a day and 2 more pounds at night, right? So we probably slowed that up a little bit. but to brag about that we're super current when the weights are still as high as they are is probably a little bit difficult to do. I think we're making progress, but this higher price feed ought to tip over the pendulum, and we ought to get there quick now, in my opinion.
So how are we doing when it comes to demand for meat, both from a retail perspective in the grocery stores to just sitting down at a restaurant?
Yeah, that's a good question. To pick that apart, the retail demand has been outstanding. And that started here this spring, and frankly has continued right along. You still have a choice select spread that's over $10 at a time when we're putting a ton of choice and prime into the marketplace, which I think is still generally a good sign that the demand for that higher cut, that higher cost cut is still very much there. Now, having said that, this would be the time of year where you start to get into a little bit of a doldrum deal. Usually demand stays better until about 2 weeks ahead of the Super Bowl. And, so we're starting to narrow that window down. I think that there is without a doubt some uncertainty in the wholesale retail chain in terms of what to expect with the restaurant trade, what to expect in terms of uncertain politics, what to expect with a different administration, one that might be more aggressive perhaps in shutting down more of the restaurants than that already are. So you've got a system that's very hand to mouth. I don't think anybody is holding any big inventory because they don't want to have a bunch of inventory at risk. I think you got an end user, the Outback Steakhouses or whatever the brand is, that they're buying hand to mouth too. They don't want to be faced with having to carry a bunch of. Those places don't have big freezers in the back. They don't have trucks lined up. I mean, they are a systematic buyer. So that's good and bad, because I think, what if the demand's a hair better than what they thought? That actually prompts a little bit more of a reaction here to the upside. And that's actually the camp I'm in. I think that demand will stay better than expected. I think it'll be led, of course, by the retail side of it, that you've taught a producer or a consumer now that, hey, I can make a steak too. And it's easier on my food budget if I do it myself as to go to a restaurant. And often those habits will last. That's certainly what he did this summer, and she did this summer. So I'm more of a demand. I think the demand's all right, barring some kind of completely catastrophe, which I think we've had our share of that lately. So let's hope we get back to some sense of normal, or more normal, I guess.
Well, as we wrap this up, there's been a push in Washington, D.C., especially coming from Debbie Stabenow, to have some sort of help already there for the meatpacking industry when it comes to COVID-19, vaccines, et cetera, to keep them healthy. What are you hearing out there? Is that the possibility of getting those vaccines to them quicker? Does that then take some pressure off of the cattle guy who worries about a repeat of last spring? Loaded question, I know.
Yeah, it's a good question. It's above my pay grade. Boy, would I like to go back to the good old days of supply, demand, and the cattle. Huh?
Yeah, no kidding.
But I'll try to answer that. I know that there's been some push that way. I think that I'm somewhat optimistic that they're going to make some progress in trying to identify those as being an essential, in the chain. They actually aren't in a bad spot right now. It's just that we can't even get the 80-year-old people vaccinated right now, it seems like. But looking at I'm talking about the commercial, the producer, the back of house worker. He's actually up there a little ways in terms of where it looks like he and she are going to be able to get the vaccine. I lack total confidence actually on what's going to happen there politically, but on the plus side of that deal, the protocols that the Packer did put in place, Susan, are working. They're not killing at 100%, but we're getting, look at yesterday, 498,000 hogs died. That's a lot. Right up against 120,000 cattle. So I do think it'd be great to have them all vaccinated, but you know what? It's actually going pretty good, even without that. But I would be supportive, of course, of doing whatever we can do to ensure that we get this stuff killed on a timely basis.
All right. Well, we'll end on that note, and hopefully we get some higher prices, some movement on the cash to bring some more money to the cattle producer. Thanks,
I hope
Brad.
I'm more fun to talk to next week, I hope.
Sounds good. That's been this week's edition of Cattle Call. And just a reminder, commodity futures and options do involve substantial risk of loss and are not suitable to all investors. That's the Cattle Call. I'm Susan Littlefield.